If you're an American living and working in Australia, you've got a super. It's your retirement fund. It's pretty standard and it seems simple enough. But here's the problem. When the U.S. Internal Revenue Service, the IRS, looks at that same account, they don't see a simple retirement plan. They see a puzzle, a really complex, potentially expensive tax trap.
So here's what we're going to break down. We'll start with why this is even a problem to begin with. Then we'll get into this whole foreign trust dilemma. After that, we'll look at a so-called relief measure from the IRS, explore a pretty risky move involving Social Security, and finally, we'll cover the absolute must-know bottom line for your reporting.
All right, first up, let's get to the heart of the matter. This whole thing is basically a clash of two totally different systems, and you, the U.S. expat, are caught smack dab in the middle.
This is the question that trips up just about everyone. I mean, it feels like a 401k, right? Your employer puts money in, you can put money in, it grows until you retire. Simple. So why on earth doesn't the IRS see it that way? Well, the answer comes down to how each country defines the exact same thing.
And this is where the trouble starts. Australia sees it one way, a straightforward, tax-friendly retirement plan. But the U.S., the IRS might see it as a foreign trust or maybe a private pension, and neither of those gets the sweet tax-deferred deal a 401k gets automatically. This disconnect is the root cause of this entire tax headache.
And here it is, the smoking gun. Australia's entire super system was created in 1992. But get this, the main tax treaty between the U.S. and Australia was signed a decade earlier, back in 1982. The foundational legal document that governs taxes between the two countries has literally never heard of a super. It just doesn't exist in that treaty.
Okay, so let's follow that logic. Because the treaty is silent, the IRS has to categorize your super using its own rulebook. And that leads us directly into our next big problem, the foreign trust dilemma.
Believe it or not, the answer to this one question can radically change your entire U.S. tax situation. It's the fork in the road that sends you down one of two very different paths. One that's kind of simple, and one that is an absolute reporting nightmare. So here's that fork in the road. If your employer puts in more than half the money, the IRS tends to see your super as an employee benefit trust. That's not so bad. The tax on its growth is usually deferred. But if your personal contributions tip over that 50% mark, your super is in danger of being labeled a foreign grantor trust. And trust me, that changes everything.
So why is that foreign grantor trust label so scary? Because it means you suddenly have to file forms 3520 and 3520A. And these aren't your typical run-of-the-mill tax forms. No, they are incredibly complex returns that force you to report every little detail about the trust activity to the IRS every single year.
And if you get it wrong, or just don't file, the stakes are massive. The penalty for failing to file these forms can be up to 35% of the gross value of the money involved. It's a huge, staggering number designed to make sure you comply.
Okay, so with all this complexity and these massive penalties, the IRS did try to offer something of an olive branch. Back in 2020, they released a procedure that was supposed to give people a break from this reporting nightmare. But as you'll see, there's a major catch.
This was it, Revenue Procedure 2020-17. On paper, it looked like the perfect fix. It was designed to exempt certain foreign retirement accounts from having to file those dreaded forms, 3520 and 3520A. For a minute there, it really seemed like a solution was at hand for expats in Australia.
So to get this exemption, a retirement fund has to check a few boxes. Contributions have to be limited, withdrawals have to be restricted, and it needs to be officially tax-favored in its home country. I mean, you look at this list, and an Australian super seems to fit the bill perfectly, right? Well, here's the catch. When tax experts dug into the fine print, they all came to the same conclusion. The rules, particularly around contribution limits, are so specific and so narrow that Australian supers just don't qualify. The very relief measure that looks so promising turns out to be a dead end for most people.
So if the official IRS relief doesn't work, what else is there?
Well, this leads us to a much more aggressive play.
It's a high-risk, high-reward strategy that involves trying to use the old tax treaty to your advantage.
Okay, here's the gambit. You file a special form, Form 8833, and on it, you make a bold argument. You claim your super isn't a trust or a pension at all. It's actually the Australian equivalent of Social Security. Now, if the IRS were to agree, the tax treaty says it would only be taxable in Australia, which would make it exempt from U.S. tax.
Now, let's be really clear about this. This is not a standard everyday tax filing. As this quote puts it, this is an aggressive maneuver. You are literally putting the IRS on notice and saying, hey,
I know what your rules are, but I think the treaty says something different, and I'm going with the treaty.
And you're not exactly standing on solid legal ground here. People often bring up a court case called Dixon, but it didn't set a legal precedent. It didn't force the IRS to change its mind. To this day, the official IRS position is that a super is a private retirement account, period, not Social Security.
And here's why it's such a gamble. First, there's another official agreement that clearly separates supers from Social Security. Second, the IRS just doesn't buy this argument. Third, and this is a big one, a tax professional who pushed this theory was actually convicted of tax fraud. And finally, if the IRS shoots down your claim, you could be on the hook for all the back taxes and penalties you were trying to avoid in the first place.
So after all that complexity, the failed relief, the risky gambles, let's just cut through all the noise. What is the absolute non-negotiable reporting bottom line for a U.S. citizen with an Australian super?
Let's just lay it out. If you hit the thresholds, two forms are basically a given: the FBAR for your foreign accounts and Form 8938 for your foreign assets. Then you have the big one. If your super fits that foreign grantor trust definition, you've also got to file Forms 3520 and 3520A. And just look at those penalties. They're absolutely brutal. Which brings us to the final critical question. You're dealing with a tax treaty that's over 40 years old, an IRS fix that doesn't actually fix anything for you, and a risky legal argument that could easily backfire. So what's the one safe move? Honestly, it's careful, diligent compliance and getting advice from a professional who specializes in this mess. Because until the US and Australia sit down and update their agreement for the 21st century, every US expat is left trying to navigate this tax trap all on their own.